Good morning, this is Larry Edelson with my Uncommon Wisdom video for Thursday, December 16th. Well, I hope you read my column of this Monday. I gave a warning out that I expected a correction to begin unfolding in gold and silver, and we're starting to see that right now. So let's take a look at the charts. I'll go right to gold for you. Here's a gold chart that I've largely been following for you over the last several weeks. I did note that we had some kind of a double top here formation in gold, and that cyclically now is not the time for gold to make a runaway move to the upside. So I've updated this chart for you and cleared off some of the old lines, and you can clearly see here that the important resistance is going to be at that double top there. So I would not aggressively go long until that area is taken out. And again, cyclically, that's not likely to happen just now. Far more likely is we're going to start seeing a pullback, and as you can see here, gold is starting to break this uptrend line here. I am looking for a test of 1325 in gold, and probably more likely down to around 1250, which is this cyclical support line over here that I'm double clicking on for you right now. We're going to see that correction probably affect all the metals, including silver, and which could pull back quite a bit more sharply than gold. And we'll see it affect platinum, palladium, and the base metals as well, like copper. It is nothing to worry about on an intermediate term or long-term basis. It is a normal, healthy pullback. In fact, I would deem a normal, healthy pullback that occurs now to be more bullish on the intermediate and long term than bearish. What you don't want to see right now is gold take off straight up to the upside. That would be a very, very negative situation longer term for the precious metals. It would indicate that they had gone into a bubble type of situation, and we all know how those end. So if you're a long-term bull, philosophically as well as fundamentally and technically, you do want to root, so to speak, for a pullback to occur here and now. You do want to, of course, hold your core positions through that. Let's now take a look at the dollar index. The dollar index continues to meander a bit in here. You can see that, a week or so ago, as I pointed out to you, the dollar index broke this important trend channel support here and has since gone sideways. We're likely to get another rally, however, up in the dollar index, especially as the sovereign debt crisis continues to impact the euro and the European Union. It is now migrating, of course, to Portugal and Spain. So that will likely pop the dollar index up to about 83 over the coming weeks, which would probably also help put downside pressure on gold. But whatever rally you see in the dollar versus the euro is temporary, and much like gold and precious metals remain in a long-term bear market, the dollar remains in a long-term bear market. Now I want to move over to the Dow Industrials. Pop that chart up for you. You can see this formation here in this blue rectangle, which looks very similar to the one previously over here and the one here that occurred. I moved the box over here so you could see the congestion in the trading here. The Dow has popped up earlier this week to a new post-recovery high. It remains possible the Dow could move up to about 11,895, but it is getting very, very tired in here. And I still expect it to roll over with a sharp decline, either going into end of this year or very early in January. So again, you do not want to be heavily invested in the broad stock markets right now, except for your core holdings of gold mining shares and natural resource stocks. Till next week, this is Larry. Have a good week.